Morning friends, welcome to Adda 24/7. We are in selection MCQ series for BFM and presently we are covering most probable questions. In this series we are covering some important theory also today I'll cover. Means not only questions but because you need to understand certain things also. And then the topic is derivatives in banks. So derivatives in banks means nowadays here no bank can exist without using derivatives now, because basically that is used for hedging the risk. So watch this video completely. Let's start. Before going ahead, see this. Basically this selection batch. Hold on. I'll come to this later. Okay, let's carry on with this. So treasury makes use of derivative products for the purpose of, means why does treasury use these derivatives? Why does it use it? So it makes use of the derivatives for the purpose of managing the risk, including the risk relating to ALM. ALM means what? Asset liability management. So basically it covers asset liability management. How does it make use of derivatives over here? See here. What is the basic use of derivatives? Derivatives means it is used to hedge the risk. Hedge. What do you mean by hedging the risk? Okay, let me explain you one point over here. Now if imagine you buy a share of, let's say, which company? Let's say TCS. You buy a share of TCS. Okay. Now expecting that the TCS is, let's say, now at roughly, I don't know, but it's roughly at around 2500, let's say. Okay. Now why do I buy this TCS share at 2500? Because I buy it because I expect it to go to 2700 or 28, let's say 3000. Let's make it a round figure. I expect it to go to 3000 and then I'll sell it. That's the basic logic. But what happens? Suppose, means I'm afraid, if tomorrow when I buy this 2500 share and instead of going towards 3000, if it moves towards lower level, that is 2000. So what will happen? I'll make a loss of 500 over here. So to cover this loss, what do? I buy a put option. Put option. So what does it happen now? So now suppose if the share goes down from 2500 to it starts moving down, then my share value I lose it definitely, because I'll be losing the money in the share value. But this put option is such option that whenever any commodity or any stock price or anything which goes down, then the share price of the put option goes on increasing. Okay. So what happens over here? I lose in my shares, but I gain in my put option. So what is happening net? My net loss, which was 500, it will be reduced over here. If my put option gives me, let's say, 1000 rupees, it may happen because put option, the price of the options increases many folds. Means if TCS goes down from 2500 to 2000, means 500 down, this put option will go by around 5000 rupees, means 500 to 5000. Means this much will be the 10 times put option will give me the profit. Okay, so that's why that is the basic logic of hedging. Okay, so hedging the risk is the prime responsibility of any treasury person. Got it? So manage the risk, including the risk related to ALM, catering to the requirement of the corporate customers. Even the corporate customers will ask for hedging hedging options. Okay, means put options or call options. Why? Because they are also concerned with their money. So they can also ask for the same. Taking trade positions in derivative market. That is also an important point. Trade positions means what? Suppose if I am buying some dollars, okay, means if I expect that there can be certain clients of mine who will come to me after 2 months for, let's say, $1 lakh. So what will I do? I'll buy $1 lakh from the market. Now in between the 2 months, to cover this risk of these $1 lakh with me, what will I do? I'll buy the options over here. Those options may not be only call and put options. Those options can be something else also. It can be swaps. Okay, so I can buy swaps also. That is also a hedging instrument basically. That is also a derivative instrument. So that's why trading positions in the derivative products. Then derivatives relate to the future value and not the present value. So that is the main point. See here, put option means what? If it goes down. If it goes down means what? That's a future. So that's why derivatives will always relate to future value and not the present value. Present value is basically at the money we call it. Okay. Chalo, move on. What is the derivative then? A derivative is a financial contract that derives its value from another financial product or commodity, say spot rate, which is called the underlying. That may be stock, stock index, a foreign currency, or a commodity. Means what? Derivative does not have its own existence, no own existence. It never exists. Okay, it's like that parasite. You know the parasite? Parasite can't grow on itself. Parasite always grows on something else. Like we have that fungus on the bread, right? Fungus. You keep the bread in moist for 2 days, you'll find fungus over there. That is the parasite. Same thing over here. Derivative, option, you call it, swap, you call it FRA, forward rate agreements, anything you call it, or even forward agreements, forward contracts, what we do. You call it anything. All of them don't have an individual existence except there is some commodity backing it. Means I can have the options for Nifty, I can have the options for gold, I can have the options for dollars, I can have the options for agri commodities, I can have anything, but there should be some base over there, there should be some commodity. Okay, forward contract in foreign exchange transaction is a simple form of derivative. Forward contract means what? We have studied certain things, like suppose spot rate is given as 70 rupees, then 1 month forward is given as 30-40, next month forward is given as some 50-60, right? So that is basically the forward contract. You have studied this in JIB also and in CAIIB also in BFM, right? So that is basically derivatives. That is a part of derivatives. Here, derivative contracts, let me see if I am having it. There can be many derivative contracts. Yeah. See this, I have mentioned it over here. Futures, forwards, options, swaps, these are the main common derivative instruments used. Okay, I'll explain you them these also. Okay, so that what's important over here is swaps. Swaps are main difficulty for everyone. Okay, the major purpose that is served by derivatives is to hedge the risk. Hedge, what did I say? Hedge the risk means TCS 2500 bought, if it goes down then what? So that's called as hedging. Futures, forward, options and swaps are the common derivative instruments. Now futures means what here? Remember, futures and forwards are always same. Future and forward, there is one relationship between them. That is, future is, I'll write it over here. Future is an organized forward. Organized means forward. Okay, future is a organized forward. Means what? In forward, I can sell $1 or $2 or anything, or $1 lakh, anything. But in future market, there is a lot size given, lot. Okay, so that's why I have to buy it in lots and sell it in lots. In forward, there are only two parties involved. Two parties, buyer and seller. Okay, in future there are three parties involved, buyer, seller, and in between some third party, means who can exchange the things. Like you buy the shares, right? When we buy the shares, do you know who is the seller of the shares? Suppose if you buy, let's say, Reliance tomorrow, so do you know who has sold at Reliance? No. Why? Because there is NSE and BSE in between. This NSE and BSE creates a pool of the shares. So that's why you don't know who's the seller. Similarly, when you sell, do you know who's the buyer? No. They create a pool. Okay. So that is basically future. There is a third party involved in this, which manages the which manages the settlement risk. Okay. So futures and forwards, they are actually related. Options, I have just now told you, options are of two types. Put option, I told you. Then we have the call option, call or put. Whenever I expect any commodity to go down, I'll buy the put option. Whenever I expect any commodity to go up, I'll buy the call option. Now the difficult part is swaps. Swaps means what? There are many swaps available. Financial swap, this swap, that swap, many. But remember, there is only one logic to the swaps. Always there is only one logic. And what is that logic? The logic is, there are two legs to the swap. Two legs, okay? One leg is fixed, other leg is floating. These are the two legs. That's it. That's it about swap. Now you call it anything. You call it dollar swap, you call it gold swap, you call it nifty swap, you call it any swap, anything you can call it. So logic remains the same. One leg is fixed, other leg is floating. I'll just give you one simple example. Suppose if I take 1 lakh rupees from you, I take 1 lakh from you, okay? And what do I say? I guarantee you 7% per annum. Okay, so what is this? This is a fixed leg. Let anything happen to my 1 lakh, I have to give you this 7% at the year end, right? And what do I do with this 1 lakh then? I invest it in the stock market. So what will happen? In stock market, I can either get 50% or I can get 0% or I can get minus 50%. All the money can go. So all the three things are possible. So what is this? This is a floating leg. What I am giving you is a fixed leg. What I am getting is a floating leg. Reverse thing can also be true. Okay, both the things can be there. So remember, in swaps always there is one leg which is fixed, other leg which is floating. That's the only basic. The derivatives do not have any independent existence and are based on the underlying assets that could be stock index, foreign currency, commodity or an individual stock, right? So it can be stock index means we are calling it nifty options. Foreign currency means mainly this is dollar is considered as the base currency. So we generally trade in dollar options, okay? A commodity means it can be gold or any agri commodity also. An individual stock like Reliance or anyone, TCS, many of them are there. Before going ahead, download Adda 24/7 app on your mobile. In this app, you will be getting all the premium study materials plus live classes plus ebooks, tests, everything. Whatever needed for clearing JIB and CIB, you will be getting it over here. So download it right now. Now let's come to the question part. The payoffs for financial derivatives are linked to, means payoffs, okay? They are linked to securities that will be issued in the future, the volatility of the interest rates, previously issued securities and government regulations specifying allowable rates of returns. So here all the answers seem to be correct for you, but you have to choose the one clear one, okay? So what is that nearest one? Very difficult. It's a confusing part. Many of you will click on D, some of you will click on B also, some of you will click on C, and securities E will also some of you click, because I've just now told you that derivatives are for the future, right? So some of you will click for A also, but I'll tell you the right answer is not B, not D, it is C, previously issued securities. Here the derivatives are the instruments which are based on something. Based on something means what? That something is previously issued securities, means there should, what did we say about derivatives? Derivatives don't have a physical independent existence. They exist because of something which is there. So that something is previously issued securities. So that is the real answer, okay? Financial derivatives include stocks, bonds, futures, none of the above. So what do these include? Financial derivatives. Stocks are included, bonds are included, futures. I feel none of the above, isn't it? What do you say? Yes, futures. That's right. Financial derivatives include futures. One name I think so. We have done this just now. Futures it was mentioned. Yeah, that's what I thought. Whether we forgot that or what? Okay. Futures and options are always related. Remember this, huh? Futures and options are always related to each other. Future is always here. How does the future work? Let me explain you in simple language. Future. Suppose if you buy a flat, okay, you go for buying a flat. What do you do in buying the flat? Do you buy it offhand, everything? Full money is given to the developer immediately? No. What do we do? We first do agreement to sell or agreement to purchase from your side. We can call it, okay, agreement to sell, right? So what does that agreement to sell tell you? That agreement to sell tells you that you are buying that flat at, let's say, 5,000 rupees per square feet. 5,000 per square feet. So this is the rate I am fixing in this agreement to sell, and then I do write it that I will be giving him the money or that builder in next 12 months. Okay, so what does it mean? I am fixing the rate at 5,000 rupees per square feet up to 12 months. So if tomorrow this rate goes to from 5,000 it goes to 8,000 per square feet in 1 year. It may happen. If it goes to 8,000 per square feet, then also the developer will have to sell me at 5,000 only. Why? Because I booked the contract with this guy. So that is future. Future means giving some initial money, means I give generally 20%, 10% to that builder, right? So I book that contract by giving some initial money, and this is known as the margin money. So this margin money is always given to the builder, and then I pay the remaining amount in the installments. Same logic is used in futures. I buy the futures of Reliance. It means what? I paid 25% of the cost price of the Reliance, okay, and then I buy those that future. So what does it mean? It gives me the right to buy that stock at the prescribed date. Okay, it gives me the right to buy that stock at the prescribed date. So remember, futures are not like options. In options, what happens? If I don't exercise my options, they expire. But in futures, if I don't exercise my futures, okay, so then there is this rollover cost me heavily. So you have to close this position of your futures whenever there is a expiry coming. Okay, you have to close it or you have to roll over it. Okay. Now subscribe to Officers Adda 24/7 YouTube channel. In this channel you will be getting mainly the free YouTube series on various subjects of JIB and CIB. Free YouTube series means right now as you are watching, this is a free YouTube series. Similarly for other subjects also you are getting this. Okay, so you'll get the free YouTube series for various subjects. So subscribe to it, click on the bell icon immediately. Okay. By hedging a portfolio, a bank manager reduces the interest rate risk, increases the reinvestment risk, increases exchange rate risk, increases the probability of gains. Hedging the portfolio. Hedging. Okay, why is hedging done for? Hedging is never done for gains, profitability. It is never ever done for profits. Okay, it is always done to reduce some risk. Reduce. Okay, so increasing reinvestment risk, out. Anything risk which is increased is out. Increase exchange rate risk, out. It is, suppose if this word would have been reduce, then you would have been in a problem, because all these would have been correct then. Reduce interest rate risk, right. Reduce reinvestment risk, that is also right. Reduce exchange rate risk, somewhere that is also right. Reinvestment is not directly related to the hedging part, but then also somewhere it can be indirectly related. But as these answers are increasing, this is totally out. Hedging a portfolio or hedging any commodity, hedging anything using the derivatives is to reduce that risk. Okay, so the answer is A. Hedging risk for a long position is accomplished by, just now I gave you the example of TCS, right? What was the TCS example? 2500 I buy it, okay, and I expect it to go to what rate? 2800 or 3000, let's say 2800. Okay, so when I buy something expecting it to go to higher level and then I'll sell. Okay, so this is known as long position. So whenever I am having this long position, so hedging the risk for long position is accomplished by taking another long position, taking a short position, taking additional long or and short position in equal amounts, taking neutral position. So how do I hedge this? Suppose if I am having this long position, so in derivatives here, this is in commodity and these positions are given in derivatives. So which position should I take in derivative? Should I take another long with long? No. If I am having something here, let's call this long as plus. If this is plus, it will be nullified or neutralized using minus. Minus means it should be a short position. So long is out. Taking a short position, yes, it can be the answer. Taking additional long and shorts, here both I am doing. So this is nullifying itself. This is plus and this I am doing plus and minus. So these get nullified with each other. What is remaining? This plus. What about this plus? This long is still remaining. So that's why taking additional long short is not the answer to this. Taking a neutral position, not doing anything. Then what about this plus? This plus needs to be neutralized by somebody. So that somebody is taking the short position. So whenever you have any long position in commodity, okay, you must always take a short position, short in this derivatives. Okay, always a short position in derivatives. So I'll buy a put option over here. Reverse is also true. Means if I am having a short position in commodity, I'll take a long position in derivatives. I'll buy a call option at that time. Okay. A contract that requires the investors to buy securities on a future date. Future date. It's called as short contract, long contract, hedge and cross. Future date means hedging is not a point over here. Cross is nothing called. There's nothing called as cross contract. Okay, hedging is also out. So only short and long. So that allows me to buy securities on the future date. Now what is this contract? Now this is similar to that example which I gave you of the flat. This contract will allow me to buy my flat in the future date. But for that, what am I doing? I'm giving some initial amount over here. Initial amount, right? Booking it. Right? This initial amount is same given in this shares also or this future contract also. So this is known as a long position. Whenever it gives me a right to buy this flat at a higher rate, means at the same rate in future date. Because in future this will definitely go up. If I am booking this contract at 5,000, after 1 year it may go to 6,000. So there is a 1,000 rise in this price, but I am getting it at 5,000 only. Why? Because I had booked that contract at that time. Similarly for the futures also. If I buy a future for Reliance at let's say 2,500, so after 1 month if this Reliance goes to 2,800 also, the market has to sell me at 2,500 only because I had booked the contract. So that is known as long contract. Okay. Now these two batches, very important ones. Okay. See this selection batch. All the details are covered over here. Complete details. Also we are coming up with this revision batch. This video courses. Okay. We are coming up with the revision batch also. Video courses batch means what? Here many times what happens, you don't have time for attending the batch on regular times. So what happens, we have brought the video courses batch. In video courses batch what happens, suppose if I am having we are giving all the videos over here, so you can watch the videos at any time whenever it's free for you. You are having huge discount using this code Y432. You can use the Mahapack also. In Mahapack you are getting 15 plus batches per subject. Let me show you. Okay, let's go to Adda 24/7 live. If you are having the app, I would suggest go on the app. In the app you are getting 1% extra using the coin system. Okay, so click on go to Adda 24/7. Let me show you this. See this. Now we are on Adda 24/7 live over here. Click on JIB and CIB. Click on CIB 23. You will see the batches over here. All the batches. Look at this selection batch. That's what I was talking of. Click on the selection batch. You will see the details. All the details. Mean days, timings, study plans, everything. You will see it over here. Go through it at your ease. Okay. Importantly, I'll tell you, recorded videos are available 24/7. So that what happens, if you miss out something, then you can definitely go through the recorded videos. Now click on the offers. Look at this. Put the code Y432. Never forget this code Y432. Click on apply. Look at this. 23,999 reduces to 5,519. Means 77% off you are getting. Such a huge discount. Go for it. Because these batches are very important. Also we are coming up with the revision batch. Also we have the video course batch. Now whatever you need, we are having it over here at Adda 24/7. Let me show you the video course batch. Okay, see this. Suppose if you go to this, click on CIB. See this. You are having this. This is the main selection batch. Then you are having, just scroll down below. You will see the video courses batch. See this video course. Click on this. Again you will see the details of the courses. what subjects are covered, what are the topics, everything. Even you are getting ebooks in this. Okay, so look at the fees part, 19,549, 15% off you are getting. Click on more offers, put the code Y432, Y432, click on apply. Look at this, 15% off moved to 77% off. 22,999 now has reduced to 5,289. Such is the beauty of this code Y432, 77% off you are getting. So that's why I would suggest go for this video courses batch or the selection batch as per your timing, whether you can attend it, or if you don't find time, go for the video courses. I'll be back tomorrow with another series. Till then, bye and keep studying, and importantly, join the batches ASAP. Okay.